So today's video is about one of the best strategies for long-term investing. Not only is it the best strategy, it is a principle and rule that you must know, especially if you're new to the stock market and new to investing. It's called dollar cost averaging. So obviously the first couple things that you need to know before you start investing as someone that's brand new to investing and you're just dipping your toe in the water is what platform are you going to use when you invest your money in the stock market? And then second, it's what are you going to invest in? So let's just say you figured it out, right? Say you're in Canada, assuming you're in Canada, you use Wealthsimple because it's a commission-free trading platform. It's easy to use. Millions of people use it. You probably file your taxes on it. You probably earn 4% interest on your money inside of it. It's kind of a no-brainer here in Canada. Second, so it's considered, I said platform, but you can think of it, it's also another word you can use as brokerage, right? A discount brokerage. So now you have to decide, okay, what am I investing into? I don't know anything. What am I going to invest my money into? VFV is what I tell everybody to put their money into in terms of if you're brand new to the market. You're able to invest for the long term. You're investing in the S&P 500. You don't have to think about it. You don't need to know anything about stocks except for this concept called dollar cost averaging, which I'm about to explain. So dollar cost averaging is so very, very important when it comes to long-term investing. So let's just say you found VFE. You don't need to spread your money. You're not buying individual stocks. You're brand new to investing. You understand that you want to invest your money tax-free, ideally. I forgot to mention that. Like after the platform, you got to just in Canada, you got to determine what platform or brokerage are you going to use. What account are you going to invest inside of? TFSA, your RRSP, your FHSA, and then what are you going to invest into? Assuming you figured all that out, let's just assume you chose Wealthsimple, you opened up a TFSA, and inside of that TFSA you bought VFE. Everything's great when your account's in the green, you see unrealized gains. What happens when the market starts to fall? It's a completely normal thing, right? Over the last 50 years, there's been so many geopolitical events. There's been wars, there's been recessions, there's been tech bubbles, there's been COVID. So for example, in 2022, the market dropped 19%. Now, what do? You buy VFV, you buy an S&P 500 index ETF, and the market drops 19%. What do? Do you run away and never invest your money again, and you lost all your money, and you sell and you pull your money out because you're scared? Honestly, truthfully, the stock market is not for everybody. The same way people say that if you don't buy a house, your money is wasted going to rent. The same thing applies when, okay, if you don't invest in the stock market, your buying power is deteriorating due to inflation. But at the same time, does that mean that it's an absolute? Absolutely everybody should be buying a house. Absolutely everybody should be investing in the market. Well, if buying some sort of financial asset, right? Both things are financial assets, right? Buying an index fund or an index ETF and buying a house are both, well, let's just consider both of them assets, right? I think that not everybody, as is today, should be jumping in headfirst into investing in the stock market or buying a house without properly educating themselves on what they're doing. Not just because historically it's done well. Historically, real estate has done well. Historically, the stock market has done well. But you yourself, not your friend who knows about investing, not your realtor, you yourself need to understand what are the potential risks that come with doing this, right? What am I missing out on by not doing this? And what is the opportunity cost of not doing this? What else can I do if I'm not comfortable with making that sort of investment or purchase? In terms of stock market, you have GICs. Interest rates are not going to be high forever. That's not going to do you all that well long term when inflation continues to rise. So it's important to educate yourself. If ultimately after educating yourself you're still not comfortable, then don't do it. You know what I mean? The short-term stress is too much for you, then don't do it. Down the road you might regret it when you realized what could have been and whatever, but enjoy your life, right? You shouldn't get pressured into making a certain investment, or earn something on your money at least and minimize your expenses. Anyways, back to dollar cost averaging. Let's just say the market drops 20% or 15% in a year, right? Because you'll see on the Instagram post and the post, I actually share this with my YouTube community as well. You can see that in certain years, the market has dropped and had negative returns, meaning you have lost money, right? Assuming you got in that year, it's not looking good for you, right? If you got in way, way prior, say 10 years prior, you've still made money. You've still made money. Your money has compounded, and yes, it's not as high as it was last week, but you're still up. You've still built wealth in the market, right? Unrealized wealth, of course. You're not selling it, but yeah. If an asset that you believe in, that you fully understand that these businesses are not going anywhere, right? The S&P 500, has Apple. Apple is going to be at the forefront of the AI revolution. Apple has more money than many countries in the world, just sitting in cash. Well, the thing with Apple is it's just an overvalued stock, in my opinion, right now, because I feel like, based on things I've read, take this with a grain of salt, that all of that AI, all the positives about AI that Apple has already been baked into the stock price, right? It's worth like what, $3 trillion, something like that. But anyways, when you buy an index fund or an index ETF, such as VFE, you don't have to worry about that, because there's 499 plus other companies inside of that basket that you own with each share that you purchased. So you know that these companies that are inside are the largest and most profitable companies in the United States, which are global companies that are all over the world, that are mature companies that have been around forever, that you consume. The majority of the products and services you consume on a regular basis, the majority of the companies that advertise to you on Instagram, on YouTube, on TikTok, on the TV, if you still watch TV, on TV, when you watch a movie, majority of these companies that want you to buy from them are within the S&P 500. So you're spending money with them anyways. You know they're not going anywhere. You should know that. If any of them fails to produce and starts to not meet up to the standards of the S&P 500, they get kicked out of the S&P 500 and they get replaced with somebody who is meeting the standards. So you don't have anything to do with that. You don't do anything. You don't have to know about what's doing well or not. You're set up. All you need to know to really thrive and take advantage of this just no-brainer of a decision is that volatility is going to happen. Certain years, when the market is overvalued, the market will correct, and the overall market might go down 10% or 12%. Now, following that, historically, if you look at the last 50 years, as you can see in the graphic that I posted on Instagram and to my YouTube community, you can see that following that 1 year, or maybe one or 2 years max, the market comes back and does 28% in returns, or 15% in returns for multiple years. Basically, what I'm trying to say is dollar cost averaging helps you to build wealth long term. Why does it help you? Because you're not dumping your $10,000 into the market when the market is priced at the all-time high. Instead, what you're doing is, if all you have to your name is $10,000 and right now you want to start investing, instead of doing that, you invest $1,000 every single month into VFE, because now you're able to take advantage of price fluctuations that happen in the market. The price changes every second. That does not mean that the businesses are doing bad. That just is the price action that's happening because people are buying and selling every single second. That does not mean that businesses are necessarily doing bad if the price goes down by 20 cents or 30 cents. Think of it the same way as you're paying the mortgage on your house. You're building equity in a quality asset. That's what it is. You're building equity in a quality asset. So dollar cost averaging takes advantage of price fluctuations that occur in the market so that your average cost over time will balance out. And instead of having an average cost of, let's say, $140 because you put all your money in at once and you never invested again and you just let it sit there, and then the market went down, and 10 years later, the price is at, let's just say, $160. You're up $20 per share. Instead of doing that, at putting $10,000 in at $140, you put in $1,000 a month at different prices. You can't predict the price, but the price is always changing. So you're buying $1,000 when the price is less than $140. So maybe like you're buying it at $140. You're also buying it at $136. You're buying it at $127. You're buying it at $141. You're buying it at $142. When you average it out, that's better than having an average cost of $140. You'll probably have an average cost of maybe $137. And now you're up $23 per share, for example, over a long period of time. This is a very simple example, but I'll probably do a separate video on just with doing the numbers on this. What you want to do is invest in regular intervals of regular amounts on a consistent basis over a long period of time, and you'll do great. In the future, I hope to be able to share my, as my following gets bigger and bigger, I hope to be able to share my own portfolio and really talk about this and show you what I'm talking about. We will get there. I'm confident we'll get there. I just don't know when that's going to be, but it will happen in the near future. Dollar cost averaging. When the market is down, you need to realize that things are on sale. It is Black Friday. If the market is down 10%, 15%, 20%. I'm not talking about individual stocks. I'm talking about an S&P 500 index, right? I'm talking about if you want to buy the entire market, including the Canadian market, and you want to buy VEQT, sure. But whatever it is, you need to make sure that you understand that when the market is red, that's your opportunity to buy and lower your average cost. Or you don't even need to think about that and just consistently buy every single week. Dollar cost average. The reason I'm not scared to even say this is because the S&P 500 is the benchmark that volatility is measured against. I tell my friends this all the time. Like, the tech stocks basically account for the majority of the gains in the market. But then you have the Costco's, the Walmarts, the McDonald's, the Starbucks, the Nikes, all these other companies that don't account for as much growth because they have overhead. They have more overhead, they have more expenses, they have more cost, but they have these big brands that are not going anywhere. And they help to stabilize the index when the tech stocks go down. The tech stocks will bring up the overall market, but the tech stocks will also have times where they correct and they come down. And the other household names help to stabilize it. But I'll see you guys in the next one.